There's a couple dudes asking, "Are you gonna go live? The market's crashing."
Yeah. Like, what'd you expect?
Yeah, it wasn't looking too good. Um, okay, there we go. We're live. We are live. How's everything going? First and foremost, how's everything going, Josh?
I mean, it's going good, man. As we get more bad economic news, it helps interest rates.
It does, huh? That is correct. I think I saw something on housing demand. Home listings are up more than 60% in some cities.
Yeah, there's a couple of cities where we've seen a huge influx of listings. We're still pretty anemic in probably about 80% of the country, but
Mm-hmm.
there's a pretty stable market, and I'd say about 10 to 15%, and then the rest we have a little bit of an oversupply problem.
Okay. Yeah, we'll get to those numbers. So, housing market crash or more so just like we
Like I was
talked
talking
about.
about last time, right? It's kind of more like a correction. This is kind of what happens. The issue with it again is still it's going to be hard to have a crash because we just don't have that many homes that are going to be available. So the only way we see this happen is if people really start losing their jobs. So if that unemployment number starts spiking, which it hasn't yet, but if that unemployment number spikes, you could see a lot of homes coming on the market. And then obviously that will push down demand because there are going to be people who haven't bought a house yet, but won't be able to buy a house because they lost their jobs. But that's really the only place that we can see a huge influx of inventory and really crash prices. I think what you're going to see is more of a correction, kind of like the stock market. You're seeing a pullback as inventory starts to rise. Demand has kind of stayed the same, really hasn't increased. We may see an increase in demand as rates come down, like everybody was talking about. But I think we'll also see an influx of inventory. So without some sort of destabilization in the market, we're not going to see a huge market crash as far as housing is concerned.
Right, just a little bit of a correction. Also, I think Trump announced something yesterday, which was pretty interesting, talking about the housing market here. I didn't dive too deep into it, but I'm pretty sure you heard. He said something about new home buyers 50% paying for half a house or 50% off, something like that.
Yeah, I mean that's one of those things where it's a political talking point. It's
Right.
going to take a lot of legislation to be able to pass something like that. We don't really know what the actual inner workings of it are. Obviously, if he's able to cut the price of a home in 50%, that's going to make affordability, you know, actually achievable for most people. That would be a huge win for this market because again, it would increase the demand. The only problem is that until we do something about the supply, um, there's not really much politicians are going to be able to do.
Right. Hopefully it has something to do with my guess economically would be an incentive that government sort of paid for as they always
Subsidizes,
do.
yeah, subsidize some sort of portion of the purchase,
Of,
through a
of
tax
the home
credit or
builder,
some
right?
other. Yeah, I mean that's the idea, right? So if they incentivize the home builder to sell homes at 50% of what they were selling them for, that drives the price down for the home buyers. The only issue you run into with that is if the builder's actually selling the home for 50% less than what they would normally sell the home for, the
Yeah.
comps, right? So the homes in the neighborhood would drastically be reduced. And in doing so, would cause a problem in the housing market. We would see home prices crash. So there again, the inner workings of that would have to be worked out because there would be a lot of uproar from current homeowners about subsidizing builders and selling homes for 50% of what they would sell for, um, and stable and keeping the market stable. If they were able to report it as this was under that program and the home is actually worth 50% more than what they bought it for, or 100% more than what they bought it for, then it wouldn't have the same negative impact on the housing prices. So that could be something that they could do. I mean, they'd have to work out the logistics of it to make it make sense and to
Right.
get something passed like that.
Okay. That's what I'm
But I mean,
thinking.
that's something we've been talking about, right? They've got to
Right.
build more affordable homes. You can't build a $400,000 house in an area where the median income can afford 200,000 and expect that home to sell or expect affordability to be achievable for the average American. So they have to find a way to bring the prices down substantially without causing a huge crash in the housing market, to help those home buyers.
Yeah, sort of seems like an impossible. It sounds like they can only target a certain demographic without causing a huge disruption.
Yeah, so I mean that's they would have to probably do some sort of designated zone. You know,
Mhm.
the different zoning laws that they've put in place to help bring investment into those neighborhoods. They could do something like that, right? So they create and they designate a zone for certain single family homes, and that zone becomes its own personal little marketplace, which then doesn't drag the outlying neighborhoods down in value, giving people the opportunity to purchase homes at a lower purchase price. I mean, that's another way that they could build this in and make it work. I've been saying it for a long time. The government's got to do something about stepping in and incentivizing builders to build homes at a lower price. Um, and if they're going to subsidize them 50% of the price to get those homes built, um, there's one way to do it. You create a special zone for those homes, and it won't affect the neighborhoods. So the issues you run into with construction on high density residential or lower priced, low to moderate income household construction, you get the NIMBYs, the not in my backyards. They don't want those kind of homes built because it will drive their price of their home down, and so they fight those kind of construction projects at their local level through zoning and everything else. They throw the book at them to try to keep them from building them, which is inherently one of the problems with our housing market is the local governance and those NIMBYs. So they would definitely have to work out some sort of federal program for zoning. And I mean, I've heard ideas about throwing federal lands that they're not using to build these kind of these homes, to try to help. I think that's a great idea. Obviously, we don't want them building, homes on national parks, but there's a ton of national land that they own that was formerly used for bases that we no longer have bases on, or things that aren't in use anymore that aren't considered national parks that could be used to build large communities and incentivize those builders in that construction to really focus on building cheaper homes.
So, so then the part of the resolution might have to be opening up just different places. Well, you'd have to build kind of cities, right? You'd have to build more
Yeah, because I mean
infrastructure.
that's the problem is that they can't go in and incentivize. It would be difficult for them to do it in an existing residential neighborhood, because that would then require them to get the local governments to rezone and allow them to designate those zones. If they do it with national, with federal land, then they don't need the local government's approval except for some minor things. So it would be a way for the federal government to step in and start subsidizing the housing in the United States from a national level, um, because they can't force states and local governments to do some of the stuff that they would like to do. So they would have to work with them to try to do something like that on the local level. But if they wanted to avoid having to get local government involved at all, federal land.
Right. And we
And
we
that,
probably have a lot of federal land, huh?
yeah, I mean, we have a ton of federal land that's not in use, that isn't a national park.
Yeah.
So I think that's the one thing that a lot of people get scared of when they hear about using federal land. They're afraid that they're talking about using Yellowstone. They're not talking about using Yellowstone. They're talking about using old military bases that are no longer in use or are a fraction of the size. There's tons of other federal land that wasn't a military base but isn't a national park. So I mean, there's a lot of stuff that they can do.
Okay. So you just
And
have
I
to incentivize people to move and rebuild in another city. You need schools, XYZ, but at least you would get more supply, cheaper
Well, I think that's
houses.
one thing that people don't know about new construction. Typically, especially in California, builders are required to build city infrastructure on their new construction homes. So typically, when new construction's being zoned and prepared for construction, they've got a master plan for building grocery stores, strip malls, whatever it is, but also bringing in schools, roads, fire departments, police departments. A lot of the new zoning requirements for new construction require these builders put that infrastructure in. So it's not necessarily building a new city. It's just they're doing what they're already having to do, which is an added cost, which they're already dealing with. So again, if the government's going to subsidize 50% of the purchase of the home, um, they're not losing money because they're already going to have to do that, and it's already baked into the cost of the home. But that's a big reason why we've seen home prices on new construction rise as quickly as we have, is because of all of the extra stuff they have to put into those.
Yeah, that sounds like a mess. We need technology. We need some better technology. Possibly, what 3D. I guess it comes with regulation, but 3D printed homes. If you could build that supply a lot quicker. Um,
There's a couple companies that have started to work on it. The issue is doing it at scale,
right.
because moving the 3D printers to build a home, it's not like a 3D printer at your house where you're making a small little 3D printed image. We're talking about a 1,200 square foot house with concrete. They've got to figure out a way to improve the 3D printing process for homes to really put that at scale. But yes, that would be a great way to do it because it's going to lower the cost for the construction too. I mean, because you're dropping labor costs and you're dropping material costs a ton.
Right. Okay. Well, let's talk about this market
Mm.
crash. I guess housing is going to be whatever. So we have the and we'll get to this really quick. Let's just take a look at the chart. S&P is forming a double top at the moment, and we talked about this 2 weeks ago, right? We would probably, I mean, I didn't think we'd even run up this high, but
Yeah.
this was that Japanese carry trade deleveraging. We came up
Mhm.
so quick. I think most we had one of the highest consecutive days in history. I think it was like 8 or 9 days in history. It just kept going up. And I was like, there's no way. I'm down on my short. I shorted like right here. Now I'm in. Now I'm finally break even. But it gapped up, kept going. We started consolidating. I was like, there's no way. This is where they pull people in. Oh, we're gonna break out. And I was like, I don't think so. I'm a little nervous. I'll hedge a little bit, but I'm looking at bonds and they're starting to bid up. And I think, either way, Powell, I don't want to say Powell, but the market's kind of trapped at this point because if they do cut and it's not enough, the market sells off. If they cut too much, the market might get scared. Is there something you see? We sell off. I think you have to consolidate sideways for now. And this is a lot of the sentiment. I was eating out somewhere I was in New Mexico this weekend, and there's some, baby boomers out there golfing, rich old baby boomers, and they're talking about S&P
They're talking about
500.
the S&P 500
All they were talking about was the S&P
stock
500 and
portfolio.
what's going to happen. I was like, wow, okay, that is interesting. So I kind of butted in there, and they're, those guys at least were like, hey, we need Trump. We need to make sure the market's right. He's like, get 50 of your friends and have them go out and vote. all specific. And I was like, yeah. But what do you guys think about this market? So they, some of these boomer guys, I guess what they're being fed is, hey, we should get 50 basis points or 25, I'm sorry, 25 in the next meeting, and we're not going to see a recession, and by the end of the year the S&P will be right back up and Trump will get elected according to them. So I guess it all hinges on that. um Big deal there. So today we had the employment report, so we're finally starting to see a big flush on the downside, and we'll go to that. And I think the S&P has a little more consolidation to do. Just there's too much uncertainty at the moment. So if we go back to the beginning of this month, we did get ISM, PMIs. We got the manufacturing cycle, which has been bipolar. Is it contracting? Is it coming up? What's going on? It's been bipolar. But March this year was our strongest point, which was still pretty much in contraction. Um, so are we speeding up? Not really. We're just slumping. Nothing is going on. Sluggish. There's some strength here. There's weakness over here. The downside of this is employment. I guess this is the upside. Employment didn't fall any further. This was like, okay, maybe we're not going to get. This was our signal. Maybe unemployment is not going to spike. New jobs are a little more harder to get, right? Because you're adding. It's hard to just keep adding more jobs, but your unemployment maybe not tick up as much, just because some people are not even filing. But we did get the employment go up a little bit. Okay, manufacturing's not too terrible, but here's for me at least, my big signal: new orders collapsing to the lowest point of the year. And that means demand down the road. I mean, we know this demand down the road is weakening, going into the worst month of demand. I think airlines are starting to cut payrolls, right? Did you see some of that? The airlines are cutting.
Yep.
So the whole cycle we thought was going to reaccelerate. Now we're starting to just slump in this area. The market does need cuts. Construction spending goes negative. Yeah, this was bad. I was like, oh damn, no way. We're going negative. So
Yep.
a lot of that is real estate. My assumption, real estate is just sluggish. We're still, I wouldn't even doubt if they go back and say we are in a recession. You know, they don't call it till later.
Yeah.
You
Well,
know,
you remember what I told you? It was probably a couple months ago that we were headed to or in a recession. It's not the typical formation of a recession or the definitional
right,
of a recession. But I mean, if you looked at the data, right, you had most of our GDP growth was government spending, most of our job creation was government jobs, and then you couple that with the fact that they just revised the payroll numbers down 818,000 jobs over the last
right.
12 months. That
Hmm.
doesn't even include the 85,000 they just revised the last 2 months down.
Right. Oh, it doesn't. Okay.
No.
85,000.
Yeah.
And a lot of those are not even American jobs. Um, yeah, we'll get to that. So things are weird. This is I mean, I don't even, I told my brother, I was like, look, I don't think today what we're seeing is something you can even look to the past on what's going on. We're just confused. Like the market is getting mixed signals. The economic data is all over the place. What unemployed jobs are, payrolls are falling. There's less job creation, but the unemployment came down. How does that make any sense? Was it the hurricane? Was it this? We don't
So
know.
one of the things I might tell you is that I'm pretty sure the seasonal adjustment that they did for the holiday week on that number is actually where unemployment fell, not because it actually fell. My guess is the seasonal adjustment is, and they do a terrible job of the seasonal adjustment. So I think
Right.
that's why it actually went down, and I think they were okay with doing that because they haven't been totally honest with us about the jobs. What's to say that they're not messing with the U3 number? And if you really look at the U6 number, which is those that are part-time employees, um, they're that number rose, and most of the jobs created in this last report were part-time jobs, not even full-time jobs.
Okay, so most of them are part-time.
Yep.
And this popped up too. So you have the part-time jobs, and as much as I want to say, where the hell did my Twitter go? My trip. Oh no, it's right here. As much as I want to say, we're okay. We're not, falling apart yet. It just doesn't feel, when I see the bond market creeping up, nobody's going to come out and say anything. The bond market is creeping up. A lot of big fund managers, JP Morgan, whoever has the real data, they can see it, and they're not going to
Yeah,
tell us, hey, we're
they
heading.
started
Nobody's
this a
ever
couple
going to say
days
that.
ago.
Right. And the workers, right? Most of the workers, foreign born, native born US workers are just not coming into the economy at all. They're not the ones being added. It's mostly foreign born. Is this a political statement? Not necessarily. All it tells you is, well, if most people are native born in America, then job without the foreign born, without the
We'd have a negative jobs number.
we'd have a negative jobs number. Most of
Yep.
these jobs are from the border, which is a great tactical move by the Biden administration. I would say I gave it to him. Hey, great move. It's not about the border. It's about our economy actually collapsing. A lot of people thought they think it's a political issue with the border, and it is. But
It
no,
is.
without the economy,
Yep.
he's screwed. They're definitely screwed. But with
Yeah.
this, it
No,
at
this
least
was
gives
a
them a bump. They can hide it. So
it was a
nothing.
move for the economy for sure. I
Yeah,
mean,
yeah, nothing.
they've been looking at the data as far as the birth rate, knowing that we're not birthing as many children, so we're not fulfilling the needs that we need for the workers that we're going to need. So they're importing, workers.
Here you go. Participation rate for native born Americans, right?
Hmm.
61.9%, which is below, I believe, the average. Participation rate for foreign born, 67%. So all the labor force is basically not American. Can you keep that up? Not necessarily, because
No.
here's the thing, right? Here's the recessionary thing. Over time, who is more educated? Our biggest discrepancy here is we need more higher skilled labor. These guys are not coming in with higher skilled labor. They're coming on the low end, which is great for construction companies, which is great for the, but when it comes to actually bringing your prices lower, the products, your groceries, that's not going to happen because we need more software engineers. We need more tech. We need more of that. And a lot of that money didn't go anywhere, right? How much of the fiscal policy money is, who knows? We don't even know where it is. A lot of that we
Yeah.
have no clue. The Inflation Reduction Act,
Which wasn't actually an Inflation Reduction Act because both of them have come out and said that it was more about backdooring the Green New Deal.
right? Energy. Well, yeah, none of that makes sense. So
No.
back to this. Economic data is just falling apart. ISM services, I think this is holding on by a snag. It must be holding on by a string because this data was what, August, end of the summer.
Yep.
Um, so next print we should be seeing
A lower print.
a much lower print
Yeah.
because how many people are trying to spend more money or travel when school is back? We're back in school. The
Yep.
stress of getting back to work, you're a little depressed. You got to save money. Your credit card debt's too high in general. And the golfer boomers, yeah, they're still golfing. They don't really care. It's not going to make a difference. But as time goes by, those numbers will start to drag down for services. A lot of people are cooking now. There's trends on TikTok. Cook at home. Don't go out and buy high clothes, which is great. Where was this idea 5 years ago?
Yeah, 5 years ago.
Right. Let's see. So, I mean, I guess you get some positive out of it, but anyways, a lot of this data is coming down. Non-farm payrolls comes in, still above last month for August,
Below
which,
expectations,
but
and
below,
August was
yeah,
revised lower.
there we go. Below, slightly below expectations. And if we just kind of look on the chart, this one isn't the best chart to look. We're just trending lower. Those of you who know charts, you're trending lower. You have bumps higher, you bump up. And if there's nothing that we see in policy coming up, or what the heck would be our growth? What is going to reaccelerate us? I mean, now Nvidia and the AI capex spending is now starting to decrease, which was what caused a lot of this correction.
Yeah, it's
Um,
funny actually. I was talking to a friend the other day, kind of a senior level over at Google,
yeah.
and 57 years old and gonna retire. Gonna retire because they're forcing or they're requiring them to really get into AI.
Hmm.
And they mentioned that there's a huge cuts coming to Google's employee numbers because they're able to use AI instead of a lot of the coders and other things that they've been using. So AI is going to be affecting the tech jobs a ton in the coming year.
Right. That's the downside of technology, is the shedding or the reshuffling of jobs. Ultimately, there will be more jobs, but they won't be the ones today. We still need to reshuffle and convert that labor force into something different.
Yep.
And I think we're in that cycle. I didn't think it would come this quick. I didn't even think we're going to have a recession, but
AI
who
is
knows?
busting it.
AI is busting it. So if you're a software engineer and you're young and you're keeping up with AI, you have a job. That is not most people. Most people are very lazy, and it depends, city by city, state by state. But I'm sorry, the bigger cities, are they called, not rural? What do we call the bigger cities?
Metros.
The metros. They're up to date. They're up to date. They study. They're a hustle culture of America. But the smaller cities, they're far behind. They don't even care about AI. One of the biggest companies in New Mexico. I'm not going to talk too much about it because I don't think I can. But some of my family, is blah blah blah, and the people there don't want to change. They're still using systems from 2007, and they're like, "Hey, you're going to get wiped out, so you need to adjust today." So yeah, you're right. There's a lot of stuff at risk here, a lot of reshuffling, and I'm thinking we're going to actually see employment numbers come down for another 6 months. um, doesn't necessarily mean the market collapses, because the market is going to be jumping off of AI revenue, blah, blah, blah. And plus, whoever gets elected is going to spend money, in my view. I think either way, they're going to be spending massive stimulus bills. Who knows how they do it? Hopefully it's productive. We never know if it's going to be productive or not. I think I have a little more faith that Trump's going to make it more productive. But I mean, who knows? Who knows
I
where
mean,
this ends up?
Yeah, I mean, if you want to talk about, well, let's get back to the Fed, right? Because you were talking about the rate cut. So the market's what priced in 73% chance it's a 0.25% rate cut and 27% that it's a 50 basis point cut. I think it's important for the guys that watch you understand that. I think was it 8 of the last 9 times the Fed started rate cutting rates, it's been a 50 basis point cut initially, not a 0.25%. And the 0.25% cut that they did wasn't even the beginning of one. There had been a pause, and then they did a 0.25 point after a slight rate hike. So the chances are, in my opinion, that we're going to see a 50 basis point rate cut, which at this point you can tell is going to shock the market a little bit. And I think that's something to really talk about, because a 50 basis point rate cut, you hit the nail on the head. I think the market either way is not going the stock market's not going to react well to either a 25 or 50 basis point cut, because at this point they realize that the Fed's doing it because they know something's up and they know something's coming in the economy. That's why they're starting the rate cuts. So you're going to probably see some flight to safety, and to pulling back on some losses.
Yeah, let's talk about that. I'm pretty sure the Federal Reserve Beige Book was the worst, um, language that we've seen for since 2022. So they're starting to come out with the commentary that, hey, things are looking bad, things are deteriorating, and it's all language. Anything could happen right away. So we know that's coming. The Fed sees it. I think today, Bullard, somebody came out and said, look, we need a cut
We need to do
sooner than
50,
later. This is
and
50.
it's too late.
It's too late because we're looking at backwards looking data. The unemployment, even though it did go down, that was last month. That
Yep.
was last month. This month, is it really, we're looking backwards. What's our forward looking indicators? Is that damn ISM, because those
Mm-hmm.
are the supply chain managers that are looking forward to the next month. And both employment was down. I think services was down also, but the new orders is the big one. The new orders, they're not going to hire more people unless they know they have at least, I think it's going to be at least 75 basis points before we get an actual, the economic cycle actually starts to pick up. So yes, the market is pricing in 70% chance of 25 of a 25.
Oh, it's 70-30 now.
Yeah, it's changing
See,
every
it's
single
it's
day.
yeah, that was I think 72 or 73% earlier this morning.
Let's see. Well, check this out. A month ago it was 32, and then a week ago it was 70, and then a day ago it was 60. Now it's back to 70.
Yep.
So I'm not even paying attention to this. I think it's irrelevant. A lot of people are like, how much are they going to cut? Just look at the stock market, honestly, and look at the unemployment numbers. Not unemployment, I'm sorry. Let's look at the growth number. So what do we have to look for here? A lot of people look at, there's a lot of different growth stuff, but I think retail sales is going to be a huge one. I think that's going to go completely negative going forward. Inflation looks really good. Now
It
it's
does.
irrelevant. It's irrelevant at this point. We don't have any estimates for core. I don't know why, but check this out. Consensus for is this next week? Yeah. Consensus for next week is 2.6. That would be the biggest drop that we've seen, 3 points, right? From 2.9 to 2.6. If it comes in line, that would be the biggest drop since last September when we had the big rally fall. Well, this was almost, would you call this a growth scare? Huh. I think this might have been a growth scare and then it wasn't so bad. So anyways, you had inflation drop significantly, the market rallied like crazy, except for this time we don't have GDP growth backing us up. Fiscal spending has pretty much reached a peak. CapEx for AI has reached a peak. Where's the growth come from? I don't think we see it until somebody gets elected and actually starts spitting out some of that spending, which really won't go into effect maybe till March of 2025. It's
Well,
not going to.
heck, it may not go into effect at all. I mean, if you want to talk about the some of the government spending that's been done or at least been earmarked, some of it hasn't even been used. So I mean, there's a lot of stuff that they talk about. We're dumping money into the economy. If they're not giving it directly to the people, and it's more of investment in infrastructure, that
Right.
kind of stuff isn't coming out as quickly as it used to.
Yeah, now I'm starting to think, you know what, we are looking. I know we talk about this, constantly, but the economy's changing again, right? In the 60s and the 70s and the 50s, it was all big oil, big industrial manufacturing. And then all of a sudden, those earnings collapsed after the inflation shocks in the 70s and the 80s. And next thing you know, the economy sucks. You get the worst economy ever. Stocks go nowhere. Gold explodes. Oil explodes. And then there's this transition into technology, supercomputers, or not supercomputers, personal computer, late 80s.
Personal computers. Yeah, that was a little too early for
Yeah, it was
supercomputers, brother.
a little too early. Well, maybe we'll see that next month. But anyways, yeah, so maybe we're in that period where it's like, hey, yeah, we're gonna get a big technical boost, but the real economy is gonna have to shuffle around a lot and it's gonna be painful. Where again, the reason I advocate investing so much for people, and I wish they knew more, is because you're not promised anything, but you know what is promised? They will prop the market up because all their capital, the government has to borrow more money and spend it, and that capital is going into the technology. It's always going into tech, it's going into infrastructure, it's going into energy, it's going into manufacturing because they need more weapons, because they need to make things look, they need cities to rise, they need to increase the population growth, they need to increase XYZ. So you want to own that. But maybe we are going into that period then in the next 2 years where employment really suffers in certain areas. It's probably not going to be widespread because all the immigration, illegal immigration, there's going to be a lot of demand for labor in construction. I mean, here in Phoenix, I'm telling you, it's insane how fast they're building.
Yep.
Insane. Like, I swear, every other month I look over, there's a new store or convenience store. I'm like, and then now I can't even drive down the damn. I literally moved next to the highway on purpose so I can just get out. Right
Yep.
now, it's taking me 3 minutes
30.
when it took 30 seconds. 30 seconds to get to the
All the
highway.
construction, huh?
Now it's three. Well, it's all the people.
Yeah.
It's all
Well,
the
I mean,
people.
honestly, I think what you're experiencing in Phoenix is a little bit lagged behind what we saw in some of the parts of Texas and some of the parts of in Florida, where
Hmm.
now we're seeing an oversupply of housing because they were like, look, there's a huge demand because people are moving here. We need to build housing. So they really got going on the housing. And I think they overshot, which typically builders do, because especially when they're trying to compete against each other to get the homes to market. Typically, you see a little bit of an oversupply when there's new construction. So I think that's what you're seeing in those markets that you were asking about earlier in the drops.
Right.
Phoenix could experience some of that, but it may not. I mean, because as the economy starts to slow, builders will start to pull back. They'll stop. They'll delay projects so that they don't put themselves in a situation where they're stuck with a ton of inventory.
Yeah.
And
This is.
honestly, Yeah, and honestly, I think they're looking at it from the standpoint that they still have a pretty good margin on those homes. That there's plenty of things that they can do to incentivize people to buy those.
Right. And it's regional, right? Like where you're at to make money as a business, but macro wise, this is our macro right here. Check this out, Josh, and let me know how you like this. So this macro micro, I've been using it for a while. They're coming out with new tools. So what I can do is put together this stacked chart where I have new home sales, building permits, pending home sales, existing home sales, and they're all measured the same. So you can only stack the data points that are measured alike. And
Yeah,
I can basically get an index for all these together. So you're
that's
seeing the
pretty
macro
awesome.
index. Tells you the percent in between each. But it's yeah, we kind of came up in last December,
Yep.
and then we rolled over, and then now that rates should be falling, it's a tricky situation because rates fall. So does the demand really pick up? Or is it only going to pick up for those people who have the money to switch, but it never really shows up in the data because the new people who don't have jobs are the ones who are getting unemployed. They can't do anything. They're
Yep.
stuck in apartments, right?
Well, they're either stuck in apartments or they're scraping by and paying that mortgage that they got at 2%, and letting everything else go. Because I mean that's something I had a conversation with a client yesterday. They bought their house in 2018, refinanced in 2020. They're sitting on 2.5% interest rate on a 30-year fixed. Their payments like $1,200 a month. If they
Right.
had to move out and rent, they'd be paying almost 2,500 a month in rent.
Yeah.
And so they both lost their jobs on unemployment, and they are literally paying their mortgage first, and then everything else, then food and utilities. and they're going to scrape by until they can find a job because they know that they can't afford to let that house go. So those that are losing jobs, unless they lose it to foreclosure, which most of them will fight tooth and nail and to not,
Right.
simply because they can't afford to move. So I think that's still a huge roadblock in that inventory rise that we could see. So I think again, the people, you're going to see an increase in supply. You're going to see an increase in demand as rates come down because those people who can move, sell and move will. But yeah, I think it's all relative, and I think it'll all kind of be hand in hand.
Is this in California?
Yeah, they were in California.
Damn. So they lost. See, I don't really know anybody yet that's really materially lost their house. But again, California as a whole, right? You guys have more GDP than most countries, so you're
Yeah,
pretty much your own country there.
yeah,
Funny to talk about utilities. We talk about utilities. They are paying their mortgage, right? And they're paying their utility bills, obviously, to live. And this is just a good little introduction. Defensive stocks, right? When we talk about defending yourself in the stock market, just to be a little, yeah, this is an XLU, just for educational purposes. The utility sector is going straight up through all this weakness. It hasn't really seen a decline. It's pretty strong. You can find certain utility stocks, but this is like a defensive way to defend against a recession if you wanted to. And they have, dividends and all that. But you got utility stocks, and then you have staples, because I'm guessing your friends or the people they're still buying toothpaste, toilet paper, um, and all those things that they need day to day. So then you have consumer staple stocks straight up, right? Pretty clear there, going straight up because they're defensive. And then I think that last one is healthcare. I mean, damn, don't they really screw us with that one?
yeah. That one's going to be a huge or drag on most people in their households.
I don't even remember what the damn healthcare ETF was, but yeah, they're all going up. So that I just wanted to throw that in there is, hey, whenever there is a recession, there's certain stocks that or I don't want to say individual stocks because some companies are competing, but there's certain sectors where you could have
Sectors,
exposure.
yeah,
Yeah, there you go.
like alcohol.
Right. Well, nowadays alcohol is kind of falling apart because the new generation doesn't want to drink anymore.
Yeah,
Now
it's
it's like
true.
it's nicotine pouches, nicotine companies, and who knows what else it is. This was interesting too. Households net worth. Um, it is at an all-time high. So they preach this on CNBC a lot. They show how households are the richest they've ever been, right? But when you measure it, aren't households always the richest they've ever been over time, right? Isn't that always the case?
Yeah, especially with appreciation in the homes.
Right. So I flipped it year over year, and you can see where, if we take, let's see, nonprofit, let's not do that. Net worth. Let's just do net worth. If we look at net worth, no, the highest net worth on a year over year basis or momentum was Q1 of 2021 when we had all that fiscal stimulus. Last time before that was 2004 when we actually recovered, and then I guess after '08, it wasn't that crazy. It was this 2015. Yeah, so this is what it really is. We're kind of midway. We're not really that rich, relative to everything else. Now assets are rising, but still, it's not like ridiculously high. So we're kind of just stuck in this mid period.
Yep.
So that's kind of false. It's just the data is so tricky, man. The data that you hear is such. I'm tired of hearing a bunch of bullcrap data. And then GDI, you were telling me about this GDP versus GDI, was it?
Yep.
Okay, and they're starting to divert. There's a huge
Yeah.
spread between those.
Yep.
And I guess what I heard was, and I'll pull this off a little bit. What I heard was somebody was saying that, so GDP, gross domestic product, all the goods and services produced in a year, whatever, it's everything produced, and the worth of it, the value of it. But if people cannot purchase it, it's not really a great measurement. So you look at incomes because they're going to have to spend, they're going to have to save. So GDI is gross domestic income, correct?
Yes.
Okay, just making sure I never look at it that much. Now we have the biggest spread between the two, which suggests that
The goods and products are outpricing what the incomes can afford.
Exactly. So we use the word inflationary, but it's a lack of purchasing power. Purchasing power is
Yes.
getting destroyed, right?
Yes.
Absolutely destroyed. And this happened actually in 2000, was it 2001, before the 2001 crash? It was one of those, I think, or maybe it was '07. It was one of these years before the big recession, before something actually broke. The GDI started to separate
Yeah, I think
significantly
it was
from.
actually 2007 because that's when we saw, that was a big portion of that came from the mortgages that people were getting that they couldn't actually afford based on their
Mhm.
incomes. So that
Okay.
that that debt they were taking on, or the products that they were taking on, were being paid for by things that they couldn't actually afford
Right.
because
Okay.
the incomes weren't actually rising with those costs.
So maybe that's what's going on here. Because I look at the stock market, I'm like, hey, we're doing well, but it's me. It's a small, very minute group. And although that can keep running, it's good to know that, hey, well, if people do start getting job loss, that's when it's pretty much over. Because now you get deflation. That's what the market is selling off on today, which is, hey, a lot of companies might have to lower their prices a lot more. Their revenues come down, their earnings come down, and that's not the issue. That's fine. But what they're going to do is cost cut. They're going to cut their costs, and the biggest cost is labor. So there goes that. What is the government going to create more stimulus? I mean, it's
Well,
Congress.
I
They
mean,
have to get past Congress to
yeah, I
do
mean,
that.
the part that you hear is that, there's two sides to this, which is government will step in and do some sort of universal basic income, or stimulus is what they call it now. Or you have the other side of the coin, which is, well, we have to innovate, we have to start cutting costs, at the federal level so that we can pass that back to the consumer, and then, obviously innovations, encouraging infrastructure, building out things that will create jobs. So I mean, where does that come from? Because that's the talking points from both sides, and I think people miss that is that one side saying, "Look, the government's got you. We'll support you," which is just more government spending, universal basic income or STEMIs. The other side's like, "Look, we're going to invest in businesses so that those businesses can really start investing in you, right? Creating
Right.
jobs, whether that's construction, building out, creating new types of jobs. Like there's got to be something that one of the sides is right, one of the sides is wrong. It just depends on which side of the aisle you land on. But
Right.
I think for the economy, the best move forward is some sort of incentives and push towards businesses to keep people on, hiring new jobs. Um, whether it's companies building out new projects, whether it's them building out, new. I mean, heck,
Hey,
you,
well,
go,
Trump just introduced a little caveat, I believe, to the tax cuts, which he said you're only receiving a tax cut if you're building your product in the U.S.
yep, yeah, yeah, yeah. So I mean, he's pushing it to America first. I mean, that was one of the
Right.
things that he's been saying all along. But I think I was you got him talking about how he's going to bring Elon Musk in
Oh yeah.
to to do a complete analysis of all of the government spending and start cutting
Right.
costs. I mean, that's something that we've never had. Our
Mm-hmm.
oversight committees are already bought out, so they're not doing anything to prevent, government waste. I was listening to Cash Patel on a podcast, and he was like, "Look, one of the things that we really want to do is we need to fix the power grid in the United States. If they invest in redoing or revamping the power grid, that's a ton of jobs because the power grid is huge in the United States. So
Right.
that's a lot of people having to get on the line to try to fix what the problem is. That's going to require companies hiring people to innovate on how they can improve the power grid. That's construction workers, people who are going to have to go fix the actual power grid itself. So I mean, they're talking about, doing some things that would actually create jobs.
And increase productivity at the same time,
Yes.
which is what we need because we don't need and a lot of the issue for some of you, DWIL, we're here to explain the economy and all that, break it down. Josh knows this stuff. Um, we need productive growth. We need productive spending. We're never going to spend down the deficit. That's kind of not in this fiat system, but you need productive growth where it eats away at the debt without targeting the debt. It just eats it away because there's more assets being built. And so when you spend on a lot of services, unfortunately, a lot of services like healthcare, services, social work. Look, I grew up, I literally got my master's in that area, and it's a waste. People don't learn nothing. They don't really help anybody. It's a bunch of government job spending to people who, sorry enough to say, but I worked with them. They're lazy. They expect always to be paid. They don't take any risks. And you're not really being productive because you're teaching university who's been taken over by ideologies. You're teaching these things like your self-esteem is so important. How about working out? How about eating right? Right? They
Yeah.
don't really focus on the things that are productive for the human. So when you create a bunch of those people, they're consuming and they're producing nothing. Versus we target the grid, we actually get more, energy costs come down, electricity costs come down, AI increases. AI increases it slows down the time for you to do X, Y, and Z. Or I'm sorry, it takes you less time to do that. Now you have more time to do other things, right? And you start to actually bring more production and efficiency to the market. So I think Trump, and not to make it too political, but it seems like Trump is more liberal and more progressive than the damn progressives, because he's saying some pretty extreme stuff
He's
relative to the past.
I mean, honestly, with and again, not trying to get too political, with RFK Jr. joining it,
Mm-hmm.
you realize that party has encompassed a larger portion of, uh, you know, the political landscape
Right.
and progressive ideas than they have in the past. Although it is very centrist on populist ideas, which can be bad, which can be great, right? Because they're encouraging uh, more growth for the population itself. They're standing behind things that people are actually talking about.
Right.
But I think that's the part about this that I don't think people understand is that um, that that person that one party is encompassing a lot more of the values and core beliefs in a strong economy that is progressive and spending money in the right ways versus more of the progressive far left thinking the government should be creating and giving all of this money away as universal basic life. They're the saviors of all of this, and I think that's the biggest problem that we're going to run into is that if we continue down that path, we're going to continue down the path of spiraling debt, and just a difficult situation to be in.
Do you think the whole spiraling debt thing is something that we'll ever solve? I know a lot of people, like, are we gonna? Is it realistic from your perspective to actually get rid of the debt? What is the goal there?
It's not realistic to be able to get rid of the debt entirely.
Mm-hmm.
I believe there's a way for them to cut some of the debt, and get us back in line with what's normal, what's something this country can actually maintain.
Like a better
Um,
ratio.
yeah, and that's the part that they have to really focus on is getting the GDP to debt ratio in line.
Mm-hmm.
If they can do that, I think it's sustainable. But I mean, you put your tinfoil hat on and you can say there's plenty of things that could happen that could wipe out that debt that isn't paying it back. You know what I mean?
Right. Yeah. I mean, I know the tariffs is something that Trump talks about. I don't know how. Like, I was talking. I mean, hey, I'm voting for Trump. That's just how it is. But I do understand, like, when you do mess with stuff like that, the tariffs, it all sounds good. And I'm like, I'm hoping it does work. I'm hoping
There's
it
always
works.
a positive and a negative to every single policy, right? And we've done the tariff thing in the past, and it didn't work out too well. So I think there's there's a fine line that can be walked that it can help. Um, but I also think that lowering income taxes isn't necessarily a bad idea because you're putting more money in the people's hands
Right.
that can spend it, right? That can survive on a little bit more or a little bit less with less income taxes. Because I was somebody did some video on the amount of taxes that we pay. I mean, we pay tax on tax on tax on tax. So I mean, the tax dollar that we're receiving is taxed multiple times while we're spending it. So the amount of tax that we pay is far more than just our income tax, and I don't think people realize that. So it's not a tax problem. It's not a revenue problem for the government. It's a spending problem. So that's I think why you're seeing a move towards, trying to streamline the government a little bit more so that we can cut some of that spending, but then also, do some spending where we can actually create some additional revenue through jobs and infrastructure.
Right. And
And
a
I
lot
think,
of that
yeah, and I think that's just like
money.
the fine line you have to walk. You know what I mean?
No, you're right. A lot of that money that you're talking about with the taxes, imagine if it was in people's pockets. Well, now that money is trapped somewhere in the government. We don't even know where it is. We can't even track it. That's this legacy system. It's always gonna. I think
So
everything
much
comes
money's
down.
missing.
So much money is missing and unaccounted. Just like 2000. You know what's fun? Check this out. Did you know in 2001, before September 11th, it was like 3 days before the planes hit New York, the
I heard this.
government was actually on the hill being target not targeted. Ooh, what is
They
that?
were being audited, I
They're
believe.
being audited, and there was like 1 point. I don't know if it was it trillion or
It was trillion.
it was one. Okay, so you do know about this. Yeah.
Hmm.
They're being audited. And what do you
And all
know?
of a
They're
sudden, that just went away.
boom,
Yep.
boom. The World Trade Center gets hit.
Hey, you got
Let's
your tinfoil hat on, bro.
let's destroy all the receipts, right? Or the possibilities, the connections. Wild. So when I saw that, I was like, dude, everything comes back to crypto. It's funny. Everything comes back to Bitcoin ledger to keep a record of everything. Now check this out.
Dear God.
Here's how much we get taxed. I never think about it. You just think, oh, tax one thing, income tax, payroll tax, sales tax, capital gains tax, real estate or inheritance tax, self-employment tax, excise tax, corporate tax, dividend and interest tax. And I'm sure there's other ways to tax people. So there's
Your employer's tax on the money that they make, your tax on the money they give you. They pay taxes on the money they paid you. Then
right.
you pay taxes on just about everything you buy. So yeah,
Most powerful corporation on the planet is the
dude.
US government for
Like I
sure.
said, it's not a revenue problem.
Right.
They
It's a
keep talking
spending
about,
problem.
well, the tax rate was 90% during this era. You do realize that they didn't pay sales tax and a lot of the other taxes that you have now. So no, that wasn't 90% and then all those additional taxes. That was literally the only tax. So I mean, that's the part that people have to understand is that, again, this is not a revenue problem for the government. This is a
Mhm.
spending problem, and they have to find a way to, you know, to really cut some of the fat, because I mean, pork belly spending has been a term for as long as I've been alive,
Right.
and nothing has ever been done about it. So I mean, we need, and we're supposed to have oversight committees that are supposed to keep an eye on this stuff and try to prevent that stuff. But typically, those oversight committees are, bought and paid for by the special interest groups, and they're not
Right.
holding our government officials accountable for where they're spending this money, because some of this money is just being thrown away, and then there's a lot of money that they can't even account for. I mean,
Right.
I'm gonna try to film a video on it today, but California passed a law which is now giving access to the California Dream for All program to illegal immigrants. So the Dream for All program was a down payment assistance program that they rolled out 2 years ago. It lasted for 3 days. The funds that they had earmarked for it lasted 3 days. That so many people got in on it, and basically, um, it was up to 150,000, but 20% down payment, and it's a shared appreciation grant for a down payment on
Mhm.
a house for specific types of home buyers. So it was so successful the first time, they're like, "Oh, we'll do it again." So they earmarked some more money for it. They did a
Mhm.
lottery system this time for it, and this is for citizens of the United States, and legal immigrants can use this program currently. So they did the lottery. Only so many people got accepted into it, could use the funds. They ran out of money. But they then take that same Dream for All program and now have copied it, pasted it, and now added it to an option for non-U.S. citizens, non-legal immigrants to access this money. The problem with it is that, and this is why it's pork belly, it's not because it's being given to illegal immigrants. It's because an illegal immigrant cannot finance the other 80% to use those funds. So there
Mm.
is no way for them to be able to even get this money. So they're going to earmark billions of dollars for a down payment assistance program for people who won't be able to access it. So I ask you, why are those funds not being just added to the current program, expanding it for more people to use the program that are here legally,
Mhm.
lawfully, or are U.S. citizens? Instead, they're using it as a talking point and a political stunt for votes, which again, I don't understand because that's not something they're legally allowed to do.
Right, and yeah, that makes that's dude, it's a mess, bro. I really am thinking like, hey, maybe it'll take till 2030. There's no transparency in the government's rails of money,
Put
and
them on blockchain, bro.
put them on blockchain. And who's to say that they can't? Certain parties cannot create these slush funds. Never, that money goes nowhere, but because it's unaccounted for, they're able to actually pay for their campaigns with it somehow. We don't know. We just don't know. So it's like you cannot trust these when they speak the way they do. I just don't trust them when they say, oh, like Kamala Harris's new her new accent, right? Oh, it's not a big deal. It's sure it's not a big deal. She's talking Southern, but what it tells you is there's a lot more fakeness to fool you, to manipulate you than Trump. He's an a-hole. He's crazy. He sure is, but at least you get what you see. You get what you see. You know what you're dealing with for the most part. And over here, you're being fooled. Are you kidding me? You're being absolutely fooled. We know we called it 6 months ago. Joe Biden, we don't think he makes it to the end of the year, right? I wish there was a application that showed how many times. Oh, I guess you have the betting markets, right? So it's just ridiculous, and I think people need to look deeper into this stuff. And there's a lot of FUD out there. There's a lot of made up stuff, but yeah, look deep into it because it always comes down to economics. Now, what do you think about this war? We have oil finally starting to break, and my assumption is the war is not accelerating. It's starting to calm down. It's not going to continue, and demand is falling now. So this breakdown in oil should pretty much crush inflation. But have you heard anything about the geopolitics?
Yeah, it's interesting that it's crashing like it is because there was a recent some recent information that was released that they weren't as close to a ceasefire deal. So a ceasefire deal was not as imminent
Mhm.
as Biden has been talking about. Netanyahu's come out and said we're not even close.
Yeah, I wonder if it's just demand then, just global demand is coming down. I think this is a signal, kind of like we're saying.
Yep.
I mean, it has to be because the signals happen way before the news. Because if you're an insider, you actually run your business. You're gonna say, "Hey, look, we're not buying this. We don't need this anymore. We have to shave down our operations a little bit." So I think that's might be what we're seeing. Plus, the war is not accelerating there. At least Ukraine, I have no clue what's going on there. I'm thinking this thing tanks if Trump is elected, also because new
Yep.
oil, new
Drill baby
drilling,
drill.
and the end of both wars, more than likely, the end of both wars. So oil demand drops, our gas prices finally come in a little lower, right? Insurance maybe comes down, who knows?
That's not happening.
No,
No,
car
I mean there's
insurance.
there's a lot of there's actually a pretty good political action group that's working on some lawsuits, but there's been some deep dives into the insurance industry and its relationship with politicians. I have a buddy in Florida, and after doing a deep dive, they've realized that DeSantis and a lot of the politicians in Florida have been in the beds with insurance companies, being funded by large insurance companies and their special interests, and it kind of makes you wonder, is this inflation really, or is this insurance rise really all about the global warming and the increased number of hurricanes, fires, whatever you want to call it, or is this more in line with, hey, we haven't been able to raise our rates that much, we need to make a little bit more profit because we lost $3 billion writing bad insurance policies.
Right, right. Yeah, that does make sense. You're probably right. I mean, we just, like I said, we can't see it. And now I just focus on the language of how they talk. Like, are they going to be for real? The political talk is it's just too much. Nobody wants to see
Yeah,
it.
well, I think I saw something the other day that State Farm got approved to increase their insurance rates in California by 50%.
What?
Largest insurance rate hike since they implemented the caps and the requirement to get approval by the state government. So State Farm just got approved for a 50% rate hike on their insurance in California.
Bro,
So
California,
insurance ain't coming down, bro.
dude, they're just draining California.
Yeah.
I mean, what, bro? The
Every
taxes,
every day I'm like, bro, I wish I could convince my wife and my kids to move, because it's getting rough out here. It's getting very tough.
yeah, everything is stolen. You guys are literally getting robbed.
Yeah.
So here's the last rate cuts. We'll go over this last time the Fed started cutting in 2007, the market pretty much rolled over and crashed with the rate cuts, but that was something broke. 2001, something broke. Well, September 11th happened, and the market was already trying to recover from the tech bubble. But even before that, I mean, we're not this elevated. I don't think the market is that elevated compared to the tech bubble. There was companies going up 150% in, I heard like 3 months they were up that much. So I don't think we're there yet. But what I think we are comparable to is here in 1991, or maybe it was 95. Yeah. These are recessions, by the way. These highlighted are just the recessions that we went through that are called after the fact. So we really never know. But the last time the Fed started hiking or started to cut in 95, I think we're looking a lot like 95. We started to cut. And this is the Fed effective rate. So this isn't the real rate cut. The real rate cut happened about right here. Happened somewhere right here. And the market did fall like 3%. It wasn't too much, but I think we're more so looking like that because we're in the tech boom, and there was probably a lot of job loss at that time, but a lot of excitement. So I'm trying to figure out where's the market. What does the market usually do?
Markets
When,
usually will be going down during rate cuts, typically the cutting rates because the market is heading down. So, I mean, the Fed has the data and they know that the stock market is not going up um, in the near future. That's why they're starting to cut rates.
Here it is. This is it right here. Yeah, it only came down for 2 days though in
Yep.
'95. And then it bounced. Um, once the growth came in, not too bad. But are we in that situation? Is the question. Are we in the situation where also 2019? I believe you remember 2019. I remember this very
Yeah, that one's kind of an outlier because of COVID, bro.
well. No, well, before COVID, we
Yep.
were. I think the Fed stopped cutting
Yep.
in. They stopped cutting. Are they? Yeah, they stopped raising. My bad. December of
Yep.
18, because I was crying. I was first time I started investing, and I bought Meta. I bought Facebook, and I went all in, and it was down, and my account just got decimated. I was depressed for a while, and I remember when Powell said, "Okay, we're no longer hiking," and it went up. Now, when they started cutting, I guess we had a little rough patch, but this was around the tariff stuff, huh?
Yep.
Yeah, that's probably it. It was tariffs and rate cuts, the threat of growth. So I'm just not sure. Maybe you might be correct. We might go into January flat. Um, I hope. I don't really know, but I am long bonds at the moment because I'm like, if something clicks or something happens and we really do lose economic growth and they can't hide it anymore with all the revisions, then bonds should definitely explode. So that's what I'm looking for
Yeah,
going forward.
I'm talking to my clients about rates. Obviously, the 10 years a good indicator on mortgage rates. They kind of go up and down together. I'm telling them, look, if you can hold out another year to refinance, you're going to see a lower interest rate, whether it's a 0.5% or 1%. Because I'm fairly confident that the bond market's going to rally a little bit
Hmm.
um, with the rate cuts and with what's going to happen in the stock market with a little bit of a sell off because that money will move over to there.
Right.
Obviously, any sort of geopolitical war that expands that
Hmm.
that just exacerbates it, makes it even better, or even a bigger move. So I think that's the other part about it, that one outlier. Typically, you don't know when it's coming, but with what's been going on, there's a higher chance that geopolitical war could break out any time. So that would be another bond boom right there.
Josh, do you think we get back to where we were in the last 50 years? I mean, these were rates
No,
since 81. We
I,
came down.
I'm saying low fives, high fours, um, in the next 12 to 24 months.
So higher than we are today?
Oh, sorry, no, I was talking about mortgage rates. So
Mortgage rates. Oh, okay.
so somewhere, uh, was it probably low fours?
Low fours. We're at 3.6. Where mortgages at 6.65,
6.25.
6.25. So we're at for the 10-year we're at 3.75. So then if you said fives, low fives, I think that puts us around two,
Yeah.
maybe high two. So maybe we just get back to where we were in the from '08 to
Yeah, it's going to be more of a normal market for bonds and for mortgage interest rates. I think that's where this is headed,
mhm.
because you got to remember the Fed has um, you know different measures of where they want to be for what they want to do with the economy, and so I think they're going to go closer to their target rate, which is somewhere in the high twos, low threes, maybe even a little bit lower, because that's where their target's going to be for a more
And
neutral. I don't think they're cutting to stimulate. I think they're cutting to lessen the restrictions they have on the economy
right,
right now.
right, just to reduce the restriction. How do they
Yep.
say it? You're slamming on the brakes, and when you kind of let off the brakes, you're still on the brakes. You're just letting off a little
Yep.
more
Yep.
from the crash, right? We just letting off a little more. Now, what do you think? I mean, what do you think happens with the balance sheet?
Oh
Uh,
boy.
I mean, can't because to me, I'm like, bro, that's a lot of. What are we at? How much did we already remove?
They
We're at
said they were going to be aggressive, bro.
9 trillion. We're at 7. So they've already removed 2 trillion.
I think they're probably looking to get us closer to 4 to 5 trillion within the next 24 months.
Wow. Um,
But
I
again,
don't know. I don't know about
that
that.
that's as long as nothing else happens, nothing breaks. Um, because there are some people that are thinking that the economy is going to break here in the near future, and they're going to have to do something. And I think that they're going to give themselves some room to cut rates more if they have to stimulate the economy. But they'll always have that tool in their belt for some quantitative easing.
So rate cuts before easing,
Yep.
and only just to soften the blow, drag it out. Feels to me like they're gonna drag this out. I don't. Maybe we don't have a scare. Maybe they drag it out. They plug the holes and allow things to.
That's their job, man. I mean, that's what they're trying to do. They don't always
Right.
get it right.
Mm-hmm.
Um, but the only issue and the only concern I have is we know it's late. They're always late to the party. Are they too late? And if they're too late, they have to go deeper and they have to do more,
Right.
because if they don't, it breaks. And you don't. They're trying to not let it break, but they're also trying not to overheat it again. So they have to find that happy medium. And the only issue they typically run into, because they're good at the target rate and where they're supposed to be to keep it, at a pretty good balance. The only issue is if they started too late or they did too much, because that's typically what they do, historically speaking.
Do you think rate cuts break the dollar lower finally?
Ooh,
Because
yeah, they're gonna have to. I mean, you got to remember the rate has been putting some serious pressure on um, our balance sheet as far as our deficit. So by
yeah,
cutting rates, they're going to lower the interest that's owed on that debt, which will help. So I think that's something that's a big deal. Plus, you deal with the fact that there's a lot of other countries that rely on borrowing money, and are they
yep.
coming back to borrow money from us because we're cutting rates, and we're a little bit safer bet than say Japan.
I mean, yeah, a lot. They, yeah,
It
they
was just
say
an example, right?
right. No, right. This is where I think a lot of people don't see the Fed has to cut rates to some degree for the global economy because if things are too tight, most of the world's denominated, their debt is denominated in dollars, and if things are too tight, then the global economy collapses or rolls over, and that's only going to come back to us.
Yep.
So, like we had the Plaza Accord in the '80s and late '80s, where basically they're like, "Hey, you guys have to weaken your currency. You're crushing global exports. I mean, you guys are coming to our countries and spending 10 cents to buy a home. So um, we need you to weaken because you're going to crush us, and then it messes up the whole global fiat currency system. So I think at this point, they're trying to also get the dollar down without stimulating somehow, right? So
Yep.
if they print, like you said, if they print or increase that balance sheet, it probably falls too fast. The risk of inflation comes back. Um, and if they cut just a little and hold it, maybe 50 and hold it to the end of the year, dollar still comes down, doesn't necessarily re-inflate, inflation or cause growth to reaccelerate, but it does relieve some of that pressure on these interest rate sensitive cyclical sectors in the economy. Tech should be fine. So we'll see how that plays out. Okay. Yeah,
For sure.
there's a lot of moving parts. This is the first time where I'm like, dude, I don't know what's going to happen like in the next week, but I do know the Fed will cut, and inflation is falling like a rock. So we're probably going to have short-term pain, long-term gain is what I say. I just don't know where the short-term pain ends up. So we'll see how far that drags out. Typically September, at least for stock market, is the worst month
Yep.
because all the mutual funds, their fiscal year ends in October 1st.
Yep.
So they can start buying back weakness. They probably sold a lot of Nvidia last month, so they're probably going to start
Yes,
buying
they
back
did.
Nvidia, and that chip cycle, which crushed everybody. So I think October's the low. I'm going to call October the low, unless, I mean, Kamala's already pulling back some of her policy, right? She's already like, oh, well, actually, I'm not going to raise the taxes that much, and I'm not going to do capital gains tax. So I think they're responding. I
Well,
think
she's still planning on doing capital gains. She's just not doing as much.
Yeah, pulling back a little bit. So we'll see how that plays out. But yeah, all right, Josh, I appreciate it. I'll let you go. We'll do this again when we see macros. It's turning slowly, and eventually something's going to start moving.
Yeah.
Something's going to start moving. So we'll stay tuned on that.
All right, brother. Thank you, man.
All right. You have a good one. Have a good weekend.
You too, brother.
All right. Who do we got for the charts? Who do we got for today? Let's look at the stock market. I'm gonna go over, do a little bit of technical analysis here. Growth is weakening. If you've checked out the Twitter, you know I'm long bonds at this moment. Bonds look pretty good to me. If we look at the RSI, we are starting to accelerate. Let me remove myself. Let me get this picture a little more clear. There we go. Okay. All right. So for the bond market, RSI, on the weekly chart, or no, this is the monthly chart. This is the only chart where you see the RSI accelerating from the lows, right? Momentum is picking up for the bond market, especially we're now at the point in the cycle, a lot like the end of 2018, beginning of 2019, a lot like 2013, right? Where there's that risk of recession that we're heading into. So I think we could have a quarter of weakness where bonds absolutely explode. And that happened, 08 happened. I'm not saying this is going to be like 08. The European debt crisis, bonds exploded. Every single time they creep up and then boom, they move, and that's it. You're going to have one big sharp move. We're probably not coming back up here again. This is the bond market's not necessarily an equity where it gains value over time. It's more of a structural, it's like a commodity almost, in a sense, where there's supply and demand. It's not a company, so it doesn't gain exponential value over time. It's more so just a commodity that gives you fixed income, protects you against recession. So we're probably coming back somewhere in the middle, maybe 130 over the next 4 months, but I think we can get a quick move to about 110 coming here soon. This is the only chart doing this. If we look at S&P, right, we actually are coming from the top of the range on the RSI. We're starting to cool. Let's remove this. We're starting to cool. We're a little, bearish divergence, obviously, from 2018. Now, this isn't the best way to look at it, but from 2018, the buying pressure is slowing, right? While the market has been extremely elevated. Now, I hate looking at monthly charts because a lot of it is noise on the upside. The downside's where it's at. The upside is noise, but it still gives you somewhat of a signal. And the point is, stocks are not necessarily, they don't have as much momentum as bonds, right? QQQ, does it have momentum? Not necessarily. That momentum is coming down. Small caps actually have a little bit of momentum. They're crossing the middle bound. They're starting to expand. They're kind of coiling up still, so they probably has a little more. They have a little more upside. The Dow is whatever. The Dow's nothing now. Gold, right? Gold has been breaking out a lot. Gold, I think, is probably peaking. It maybe has a little more room to go, but I'm not too fond of gold because it's a $10 trillion asset class and it might have a sharp upside move and then it just consolidates. But I don't think it has a lot of momentum. I think if you're selling options on gold, you're good because it's going to have fluctuation. So it's better to sell, or Forex, right? They leverage up. To really trade gold, you have to be levered. It's not a great, 1-to-1 deal unless you're levered up. Period. Copper looks really good. Copper looks really good as a commodity. Eventually, we're going to get the global economy start to expand, and copper should pick up a lot. I mean, it's still on trend. You need more copper for all these data centers, for AI, for all the capex build out, for all the new construction, for all the infrastructure. So copper is probably has a bigger secular trend, right? Versus cyclical. It's a little more secular than cyclical, meaning there's going to be more of it over time that is in demand versus zinc or lumber, right? Lumber is very cyclical. The housing market, interest rate market. Lumber, yeah, lumber. You don't want to invest in lumber. Okay, now the equal weight S&P RSP. This is equal weight. It looks a little more constructive. Not too bad. These are just we don't really care about that stuff. Real estate, right? Real estate REITs picking up momentum because of that interest rate sensitive sector. So bonds and US bonds in the real estate sector, but you'd have to go find a company in real estate. Obviously you don't really want to trade XLRE. You could, but you can. I mean, it depends how you play it. Are you going to buy shares? Are you going to trade options? The options suck on there. The option pricing sucks. This is something to look out for, though. Also, we do have the Japanese carry trade starting to pick up again. Unwind. I'm sorry, the unwind. Okay. So this is the Japanese yen. And back in 2022, it spiked. Didn't it was like it was the low of the market, but it basically caused a lot of volatility in 2022. And when we come to July, this big upside move, let's go to the daily chart. This big upside move in July is what caused the carry trade unwind. So we thought, hey, the Japanese yen will weaken again back against the dollar, but now it's starting to hold, right? Now it is starting to hold. So at this point, what do you do? At this point, is this risk back on? Nobody's talking about it, but it looks like the risk of the Japanese carry trade is back on. If this continues, right? Go to US JPY. We're actually making new lows when you compare US dollar to JPY. And if that's the case, is that part of the Qs unraveling, NASDAQ unraveling, tech unraveling? We saw that this was the peak here. Now we're here. So that might be another risk. The employment picture is weakening. I don't think it's really going to collapse, but either way, the market is going to force deleveraging. It's going to force people to delever until PEs and price to earnings valuations are more undervalued. So it's at least worth taking the risk for fund managers, right? The market is basically a big web of investors, a big web of investors. And when most investors decide to do the same thing, not individually, but where most of the money's at, when they decide to do the big thing, that's the market making its decision. So I think the market is waiting to, hey, we know bad news is coming down the pipeline. We know economic growth and GDP are slowing down, but we do get rate cuts. So let's go ahead and price this in, all the weakness, so we can rebuy or reaccumulate. And I think that's going to happen October. Keep your head out for October, because October is when the big institutions can start buying back. Their fiscal year ends. We just talked about that. I think we got to mark October 1st. It happened last year. We'll go back to last year, but October 1st is right here, right? So from this date on, wherever we end, I'm going to be long puts. Okay. Not no, I'm going to be short puts. I'm sorry, which is long the market. I'm going to be shorting puts. So I'm going to sell people puts who are trying to get short. I'm going to sell puts when we get lower here. I just don't think we can continue to break this without a big negative downside surprise. The good thing too, the more constructive thing is, guess what? Inflation is falling like a rock, and it's expected to fall even further um going into Monday. So I think I put on a actually put on an iron condor here. I think I'm what am I at? No, this is the Qs. Let's go to S&P real quick. Iron condor. In the future, I want to be on here more often, but I am building the course. I'm building out a course, a macro course that really is a big, extensive, not too big, but it's extensive. It kind of goes into what is macro? What is macro? How should we think about it? Because a lot of these moves are not technical. Technicals give us a reflection of what the market is trying to do, but the macro is the underlying driver of financial conditions of, is it supportive for stocks, for risk assets, for Bitcoin, for crypto, for copper, for bonds? Is the environment supportive or is it not? And there's so many variables, right? There's one, two, three, four, there's 10 variables. So when you have more variables in your favor, then you have a better decision making process. So the course is meant to help you to understand what those variables actually are and where they come from, why they're important, and let you read for yourself and understand for yourself. And then technicals, right? Which we'll do that later. But anyways, point is we got a double top here where we should be retesting the lows technically. I think it's relative. We may not retest the lows, but what I wanted to see, what did I even come here? What did I come here for? S&P. Okay. Oh, check this out. Definitely looking for this retest. This is when I get long puts or short those puts, is when we get oversold on the daily chart. We're almost there. We're almost oversold. We're going to retest that daily chart here. So we could come as low as, who knows? I don't know. We never can know what the bottom is going to be. You can throw support and resistance out there, but we do have to watch the VIX. The VIX, when it gets super spiky, whether it's pre-market or at the end of the day, that's usually where the low comes in when that RSI is fully, overcooled. And we're getting to that overcooled territory. I think we're going to find a short-term bottom, turn up, maybe move sideways through the end of September. But let me move this back to October 1st. There we go. So I think we're going to find a low somewhere in here, maybe 520 to 530. I mean, who knows? But we're looking for that. But there was a specific reason. Why was I looking at this double top? Oh, that's what I was going to say. Yeah. So I'm playing an iron condor sideways. I think 463 and 419. So my guess, right? This is the style of trading that I just adopted. I like it. I don't have to watch the charts too much. I can create content. I'm thinking we bounce around this area, right? 520 to 560. I think we bounce around here for a minute until we get into October. Then I'll be looking to take that off. Hopefully benefit from a lot of the volatility that comes down, right? So I'm also watching the VIX. The VIX is signaling that investors are very nervous. That's exactly what it's telling us. It bounced right back above 20. We talked about this. We get above 20, more volatility, bigger sized moves. So I don't really want to play next day options unless we're super oversold, which I thought we were going to get today, but we didn't get there. For example, um, oh, we did in after hours. We did in after hours. Thank God I didn't take that then. Okay. Thank goodness I didn't take that short or that long. I was trying to long S&P here, but I wanted to flush into the close. Never got it. So I was like, no, I'll wait till tomorrow. I think we get a gap down usually on Mondays 100% of the time, right? Statistically, 100% of the time, when the market gaps down, only when it gaps down, not a gap up. When the market gaps down, let's say it gaps down to, let's say where should we gap down? 538. Let's say we go to 536, right? Let's say we gap down, nasty gap down. Well, that 30-minute RSI is going to be extremely oversold. It's probably going to come down. You can see last time it got oversold was September 24th. No, not September. September 3rd. Okay, we got super oversold on the RSI. And once you get down here in pre-market, usually you get that snapback, right? You get that snapback rally. Doesn't mean we're going, back to the highs, but you're going to get a snapback. So I think we gap down, and if we do, or let's just say if we gap down, we're going to be oversold. We're going to have to snap back, and 100% of the time when the market gaps down, it fills the gap. It does fill the gap. So where did we end at? We ended the day at 540. So my expectation is wherever we end up, we should fill the gap back to 540, right? So if I'm long here, then, or actually if we gap down, I'm going to get long in the morning. I'll probably get long in the morning. And then if the market goes up, then I'm going to benefit, right? No matter how you expect to go long, but it's the filling of the gap where that trade no longer works. Once it fills the gap, that's it. You got your trade. You just have to know it's going to fill that gap. It does it 100% of the time, unless unless the statistics changed. We should be filling that gap. Let me check on Edgepool. Edgepool. Oh, I'm not logged in. This gives us the stats. I want to make sure this is true. All right, so watch. I'm gonna turn it to Edgepool. Check this out. Edgepool.com. It's a bunch of statistics for the S&P. So we're gonna look at S&P, right? Ticker symbol SPY. Gap fills. Yep, we're gonna stick on gap fills. There's a lot of stuff on here, but let's keep it simple. Gap fills standard. So what it tells us is, I want to go to by day. See if I remember how to do this. Gap fill percentage. No. Oh, here we go. By weekday. There we go. So by weekday, I want to do the gap fill S&P by gap fill by weekday. And we're looking at Mondays. Okay, so I was wrong. The stats finally changed. But still, you can see we're looking at gap downs. We're looking at gap downs here. Damn, these statistics really did change. Okay, I guess I'm wrong. Either way, it doesn't look too bad. So basically what this means is on Monday, when the market gaps up, it should fill, which means it's going to come back down 78% of the time. If it gaps down, then it should fill back up 67% of the time. So you're actually, if you're going to make a trade, it's going to be off the gap up. So that's irrelevant. Scratch what I said earlier. Dang, it used to be 100%, but I guess the market did change. So it's gap ups that really usually fill. Well, I don't think we're getting a gap up. We're getting a gap down. So either way, if we get a little more extended, I will still buy puts because I think we're a little overextended. We've been selling off a lot. Okay, let's get back to the charts. All right, so I was wrong on that. Damn. Good thing I have Edgepool. All right, well, either way, I'm going to look for the big exaggerated gap down, a lot like we had back here. Oops. It was a lot similar on what things look like. Let me see. We consolidated, hit resistance, sold off. We did that here, except for we broke out first and then sold off. We came down, big gap down. This is what I'm expecting. Not this big of a gap down because it's not the Japanese deleveraging event. But we gapped down. And if you would have got long on that giant gap down, you would have been very profitable over the next day or two, even over the next week. So very strong overextension. You can see the 30-minute RSI is at 12. Are you kidding me? Let's just look at the 4-hour. The 4-hour was at, oh, we're getting close. The 4-hour came down to 20, 21. And right now we're at 26. So, but this was Japanese carry trade unwind. So this was like a black swan. If we don't have a black swan, we should bottom. We should be bottoming on the 4-hour chart for S&P short term. We could do something like we did back here where we come back to the midline on the RSI with that white line. We come back to the midline, get rejected. So come back to the midline, get rejected. I don't know what day it's going to be, but I think it's going to snap back. We should get that snapback rally at some point. Also, inflation numbers are looking good, right? Inflation is looking good. So if inflation looks good, it's going to be constructive. The market's not going to freak out on inflation numbers coming lower. It shouldn't. It should be very constructive. So maybe we trade lower Monday and then we consolidate on Tuesday and then come up. Or we could consolidate Monday, drop on Tuesday because inflation comes out Wednesday, and then start moving up after inflation. Either way, inflation should bring the market higher if the market continues to tank. If the market continues to tank, they're going to have to position back in long because inflation's a good deflation is happening at the moment. So big breakdown there. Okay. Bonds. Okay. We did talk a little bit about bonds, but again, I'm looking for that 110 area for bonds, and I'm using options. The shares suck. Call debit spreads, making it very cheap. Big resistance up here at 110, 109. And this is the recession protection trade, right? We started off talking about bonds, and it's, the RSI, the momentum is climbing. It's back above the halfway mark of RSI, and it's holding that halfway, and it's breaking out of a nice little wedge. We did have a wedge form. Oh, come on. We had a wedge form here. Boom. Boom. Breaking out of the wedge. Very bullish. Look, bonds is easy. This is an easy trade. Nothing's easy, don't get me wrong, but it's a simple, straightforward, slowing growth, bonds move higher. Very straightforward. And I did put this on let's go back to bonds here. I did throw this onto my Twitter because I was showing the simple moving averages, how this is the first time in 2 years we've seen the 50-day moving average actually trigger a golden cross because it's moving above the 200. Okay. So happens you get no sleep, you can't talk. Also, as the VIX rises, the bond market should rise with the VIX. We should see that. You're not going to see the VIX, right? And remember, the VIX is looking 30 days out. It's looking 30 days out and saying, I can't tell what's going to happen, so let's buy insurance against any event. And the VIX is holding 20, right? This right here is a clear indication of risk-off behavior. The VIX gets above 20, it pulls back into 20, and it holds. Actually, it pulled back that same day, and it held that day. Next day, can't get below. Next day, which is today, moves off the VIX. So S&P should be coming lower. I'm glad I didn't get long at the end of the day. Maybe I'll wait till Monday to see how steep it gets. Our next level for the VIX is 28. The VIX moves in from 20. You want to look at 20. That's the long-term average. The VIX moves in increments of 8. Okay, it doesn't mean each day. It just means the level of paranoia, right? The level of panic changes once you go 8 points above 20. Once you get 8 points above 20, the level of panic changes. Above 28, it gets to another level. Now you're going to go 8 points again, and that's going to put you at 36. Right? 36. So that's another panic zone. Right? So hopefully, if you see us get crushed against 28, then you should be long. You should be long. The market's going to be overextended to the downside at this 28 level, right? If you're seeing a correlation of overextension to the downside, RSI is on the daily, on the 4 hours, overextended, and you see the VIX get crushed. That's a good buying opportunity. Now, if it closes above 28, the risk of the market consolidating and continuing to drop will be much more elevated, right? So we don't want to see this close above 28. You don't want to try to get long the S&P if this closes above 28. I wouldn't even say get short. I would just be patient. It's easier to get long, right? Selling puts or buying is easier to go long. You only want to go short if you're scalping and you're in and out, right? Or you might want to go short if the VIX is right down here around 15, then you go short, right? If it correlates with resistance, the S&P is hitting resistance. So point being, we're back into risk off sentiment. We're back in a risk off sentiment at this point. Um, Small caps, unfortunately, I got long small caps, and yeah, they're back down to these levels. But I would say this: the Fed will cut. So my contracts are out till October, and I'm thinking the Fed cuts. These are the most interest rate sensitive. A 50 basis point cut would help small caps gap up a little more. So I'm okay with, the drawdown on the small caps as long as the Fed cuts. Now, if the Fed doesn't cut, then I'm gonna be screwed on these small caps. I think they need to cut. But if they also don't cut, my bond position should hedge me much higher. And then I can wait for small caps to recover. This is why I go out in time and I'm selling premium. I'm not buying them, so I don't lose money on time. I'm gaining money on time out to October. So hopefully that works out. We'll see. My shorts on S&P are finally in the money. Actually closed one out today, 50%. And then we'll take a look at crypto. But this is good news, man. Oil breaking down, very good news. There's no risks. There's no recession risks for oil coming down. It's just telling us the economy is slowing. Okay, the demand for energy is falling, right? Even if we look at nat gas, it's so low. I know it's bumping higher, but it's coming like nat gas is sold off. Come on, look at this. The cost of energy from 2022 is down 83% for nat gas. And now we're getting oil finally start to break down. Now it's not completely broken down, but this lower range tells us that economic demand for energy is lower. That's very positive for the market. Now, if it just like opens up way down here, then yeah, you're probably a black swan happened. Something happened. But if not, this is good news. So I'm not too worried. This is why I'm still getting long Nvidia, AMD. I want to get long Tesla. I'm still waiting. I want to get long names that are not dependent on the economy. Okay. Tech does not really care about the economy as much as cyclicals like Tesla does, Amazon does to some degree, but Meta does not, right? And we're going to look at that. So this just tells us economic demand is slowing, energy costs are coming down. What does that also do? It's very constructive for inflation. Inflation's coming down. Great news for the forward-looking market. So let's go ahead and jump over to tech. Let's talk about tech. Meta is a it's a telecommunications company. It doesn't use oil. So it doesn't care. It doesn't matter if they're getting paid by advertisers. They're getting paid by companies who sell services. The service economy, according to the ISM, is still pretty strong. Yes, maybe some goods, but for the most part, Meta is going to be fine. It's not going to crash. It might come back down here. Oh, my Mac's going to die. Damn it. Let me plug it in real quick so we can finish this off. Hold on. All right, there we go. Okay, so anyways, Meta not as sensitive to the recession. So number one, TLT. Okay, so this is Meta. Should I throw up the ticker? How does this look? Let's take a look at it. I just don't want it to get in the way of the charts. Right? Does it get in the way of the charts a little bit? Whatever. So you have Meta here, and I like this play. It's a big tech play. The revenue's insane. The margins are great. Meta's not as sensitive as to say who's very sensitive to a recession. Well, Tesla is. Tesla's going to be more sensitive because they're selling hard goods that depend on interest rates, that depend heavily on consumer demand. Tesla's business is not ran off of most of the revenue comes from consumers, not businesses, not corporations, right? So they're going to be sensitive to a recession. I'm not saying Tesla goes down big because they also want rate cuts, which is a kind of a weird situation. What I'm saying is that Meta's a better risk reward while things start to slow, in my view. Because it is, it's a what do they call it? They call it it's sort of defensive. It just isn't. It's just not as sensitive to interest rates, right? Information technology doesn't really care about rates as much as like Caterpillar, right? Caterpillar needs lower rates. I like Caterpillar a lot. This is not Caterpillar. I like Caterpillar. Caterpillar is a monster. Look at that trend. Look at that beautiful trend in Caterpillar. I mean, this is a monster stock. When it booms, it booms. Okay. When it moves, but it's very sensitive to the economic cycle. That's why it cycles so much to the upside, and then comes to the downside, and then back to the upside. These moves are big, right? This is 44% up, and then all of a sudden we're going down 25%. Why? Because it's a cyclically style. It has a cyclical style, right? That's a style factor. Cyclical. It builds industrial manufacturing. Well, not manufacturing. It does industrial work for construction, for real estate. So you need lower rates to get demand going for mortgages, to get people to build more, to get infrastructure going, because it's easier to finance. Therefore, Caterpillar catches a bid, the revenues go up, the earnings go up. You need more Caterpillar, blah, 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 right? So this is a cyclical company. So I like it, but going into the next 2 months, it might have more downside. This pattern looks great. I love the wedge, right? Amazing pattern. But my guess is we're going to be waiting until we touch. If I can find the freaking brush, I think we're going to be waiting for a little bit, right? And it's not just one rate cut. We might need 2 rate cuts. And we might need 2 rate cuts plus retail sales to be a little stronger. 2 rate cuts and industrial production to be starting to pick up. Those are 2 economic data points that we want to see pick up for Caterpillar. Retail sales. Okay, I lied. Retail sales isn't as important. It's going to be industrial production. That is important. That metric is going to match 1-for-1 with Caterpillar because it is literally an industrial productive company. So watch for industrial production when it comes to Caterpillar. Does it pick up after the first or second rate cut? Back to Meta, right? Meta doesn't matter as much for the rate cut. This more than anything, Meta just is a cash cow. I think it's more of positioning. People are rotating out of chips. So you have NVIDIA, right, who is not necessarily sensitive to interest rate cycles, but it is sensitive to its own demand cycle. And the thing is, NVIDIA has already made so many chips and already distributed so many chips. The demand over the next 2 years isn't as strong as it would be as it was. So it kind of priced in a lot. I'm not saying it tanks. I think it's right on target. I think it needs to come into this area. We're looking at what, 99? I think it's there. I think NVIDIA will consolidate around this area over the next month. And when uncertainties are clear, when the VIX finally spikes, NVIDIA's just creating a big, gigantic wedge. And eventually it breaks out. I'm going to be selling options around here. It has a lot of premium, but NVIDIA looks pretty good. Who else we got here? Who is interest rate sensitive? Now, here's your defensive sectors, okay? CEG is not doing as good as I thought it would. It is a utility sector, but if you look at the actual utilities, XLU, right? Utility sector is strong. What you do is you go and you find the holdings of the utility sector and you go find a stock that you like. Go find a stock you like. So if I go to utilities, do I even have utilities on here? Yeah, I do. Go to utilities. I have CEG. That was my favorite stock. I'm still waiting for it. I think a lot of this downside is also tech stocks coming down. It's a smaller company, and a lot of that growth is dependent on data center growth. Okay, but if you go to Duke Energy, a conglomerate, a holding company, a utilities holding company, it is a monster. Look at higher lows, higher lows, higher lows. This is a monster. Do I want to trade it? Maybe. I don't know. We'll see. But utilities are strong. How about Nexta Energy? Yeah. So utilities are pretty good at this point. Dominion Energy. Utilities are strong because people are always going to have to pay their water bills, their electric bills, XYZ. This is a defensive style. This has a defensive public service enterprise. I remember they got destroyed. Has a defensive style factor to it. Okay. Utilities are a defensive style factor. Staples are another one. XLP. I don't like these companies at all. Procter and Gamble. I don't even know if I have a list for them. Maybe I need to. I'll get a list because we want to see the top companies while the macro regime starts to shift. We want to see those. We want to see those. So now, who's not going to be good? Materials, right? Materials are literally copper, gold, metal, zinc, whatever. They're sensitive to the interest rate cycle. So we have to be careful with these. I think they're going to be a good deal pretty soon, right? Newmont Energy. Well, this thing is just going up, probably because copper or mining, whatever it is. These are mining companies. They're more cyclical. They're more concerned with the economic cycle. They're going to be a little more cyclical. Some of them are doing okay. They're doing pretty good. Lindy Company. There's a couple more. This one's actually crushing it. It's probably a good buy. I mean, they don't compete as much as the other sectors. There's like a bunch of very dominant, stable companies here. This one is definitely not MP Materials. They do straight lithium. This stock will jump whenever EV demand jumps. Who knows? Maybe 2026, 2025. This should explode. They have a lot of lithium. Just keep your eye on it. But they do lithium mining. Unless their business fell apart, they should do well. There's just not a whole lot of demand at the moment. So anyways, yeah, material is going to be very sensitive. What else we have? Industrials are not. Healthcare, biotech. So yeah, healthcare is a defensive style factor also. That's why they just keep going higher. And there's more defensive companies in this. I just have some of the big momentum movers. Some of these are biotechs also. So they're biotechs. They're not necessarily defensive. They need rate cuts. They want stimulus. But if you do look at UNH, I should have UNH on here. UNH is the standard healthcare company, biggest insurance company. It is defensive because people are going to be paying their damn healthcare instead of working out or eating healthy. They're going to be, getting their heart rate checked and getting all these pills and insurance for blah blah blah. So yeah, they're doing pretty well. They're going straight up because it's a defensive group, right? It's defensive. It is not a biotech. Merck, Novia, Eli Lilly are a little more biotechy, except for Eli Lilly isn't really biotech. It's more pharmaceutical, right? They have a theme right now. You think of Eli Lilly and Novak, you're thinking of is this Novak? No, Nordisk, Novo Nordisk. When you think of these guys, you're thinking of the current theme. What is that new pill out? That new pill is Ozempic, right? You're thinking of Ozempic. They're creating their own little theme, their thematic driver for revenue, which is people want to lose weight. They're tired of being obese. It's a concern for the population, and they're doing well. But it's not stable. There's obesity. People can just go start being fit and eating healthy without the pill, and these companies don't do as well. So they're cyclical. They need a theme. Versus UNH, you're just paying your insurance. That's it. You're just paying your insurance. So it's a little more stable, which should do good if we go into recession. I still think number one is going to be TLT though. Okay. Now going to the chips, because this is where all the momentum is starting to leave, right? We'll start with NVIDIA. We already did this. We're basically looking for this spot. When I look at the RSI, I'm looking for NVIDIA to come all the way down to 30 and show a little bit of bounce. And then, hey, maybe we have a buy-in opportunity. Super microcomputer, absolutely smoked. This thing is getting smoked, right? I want to see the weekly pop into 30, not the daily because it's a little sensitive. The weekly pop into 30 down here at this blue line, over cool. That's why it's blue, it's cool. And I want to see a small bounce, and I'm going to sell puts. I'm going to get the premium, see how good the premium is. Hopefully the VIX is up big, because if the VIX is up high, the premium is a lot more juicy. And if I'm looking at 45 days out, I'm not worried about it going lower in 45 days. It's already completely overcooled. If it bounces a little bit, my contract will expand, right? As long as vol comes down, my contract expands. But anyways, SMCI. Yeah, I like SMCI. I want to see it go a little deeper, have a flush, maybe a gap down. I think it's over. If this thing gaps down to Monday or Tuesday, I think that's it. It needs to gap down. It's getting flushed. At least for a spread play. If it's individual stock or a call option, it might trade sideways. Qualcomm. I noticed a lot of these chip manufacturers, these semiconductors, a lot of them are showing the head and shoulders. Some of you guys have probably seen it. Head, shoulders, head, knees, and toes. No, I'm just kidding. Head and shoulders, right? I'm not a believer these things break down to the lows because this is a very strong narrative, but it does tell me the cycle is over. The cycle peaked and price has peaked. So you're looking for consolidation. I really think chips need more consolidation at this point. That's my guess. They need to consolidate. I mean, this thing just absolutely disgusting. I don't even know why I have Intel up there. I told you guys to stay away from Intel. AMD, probably my favorite play for options other than NVIDIA. It is pulling into the long-term trend all the way back to 2018 when I first invested in it. I remember I got scared right here. It was at $11. I bought it. It dropped to 9. I sold. And then 3 months later, it was at 16 and I slapped myself in the face. And now it's at 138. It was at $9. Oh, I didn't know what I was doing. But coming back to it, AMD is trying to retest that bottom RSI. Not only that, but it is down. It's been down for a while. It's down what? 41%. It's probably going to come down to 50%. I can see it coming down to 115 or 120, somewhere around there. And I really like AMD. I think AMD is being shadow banned from the market. And it's only a matter of time before investors start to scoop up some AMD, right? Versus like NVIDIA has been overbought. SMCI is a mess right now. Qualcomm, they SHIT it on themselves. So did Intel. They crapped on themselves. AMD had a good report, and they're building a new chip, and they have new demand. TSM. I don't really like trading TSM. The options suck, but you can see the head and shoulders here too, right? Which suggests that this industry has a little more consolidation left. I don't think they're going to tank, just a little more consolidation, right? Maybe we're coming down here. I mean, that'd be a big short right there. So I think more consolidation. ARM holding. I mean, this thing is disgusting. It literally looks like it needs head and shoulders. This thing literally needs head and shoulders. There we go. Boom. Even lower. Yeah, these look nasty, man. These look nasty. I'm going to look for one more flush. MU, disgusting. Like, are you kidding me? That was a perfect short. Right back to the 50% retracement, and then gets crushed. Right back to 85. I'm always skeptical of MU, though. I remember trading it back here, try to break out, and it went significantly lower. I remember this in no. Was it 2022? I remember MU way back here. Yeah, these are the chips have cycles, right? Inside of information technology, these are part of information technology, but they are semiconductors. They are a hard good, and there's a production cycle where you kind of want more demand than supply because you can sell at premium prices, but once the supply starts to overcome the demand, right? Economics 101, guess what? Your pricing power is no longer there. The price of the chips comes down. People already have enough. Your revenue comes down. Your profits come down. Your earnings per share comes down. Investors start to deleverage. And that's what we've been watching. When is the cycle over? I think it's going to be mid-October, but we'll see. The crazy thing is Tom Lee called out ServiceNow. This is the only chip that I've seen that is not getting crushed. So shout out to Tom Lee. He's a monster. He knows a lot more. I don't even understand the details of this stuff. Right? Only thing I know is Chainlink, and I barely understand Chainlink's details. So ServiceNow, for some reason, has not tanked yet. Must be a good business model. Who knows? We are, what are we at? We're already at 2 hours. We're gonna finish up here. If you got any questions, throw them in the chat. Any questions? So here's a copper stock. I'm waiting for copper to bottom. I think this thing is starting to look good here. Really good trend. CMG, Chipotle. I think it's pretty much bottomed. I like Chipotle. Once it jumps above 57, should be good. Just a slowing consumer cycle. It's consolidating. Celsius. Some people are buying I mean, this thing's look at the RSI on this. This at some point, like I think I need to sell puts on it because it has to snap back, right? It needs to snap back. Earnings already over, so it's not going to be an earnings surprise. it'll probably snap back. It's a little overdone. It was at 90. It was at 100. We're down 70%. People are still drinking Celsius. I still have some in my fridge. I haven't been buying them anymore though, because I don't like how they make me feel. But I know people are still drinking these. Down 70% could be a nice trade, right back to maybe 45. So we'll see. And then crypto. Crypto, I believe, will be crowned king of the cycle going into the end of the year. It's a lot more. It takes longer than we always think. Oh, Elf. Okay. What up, Vadim? Let's look at Elf. Oh man, Alpha is getting crushed. See, I thought Alpha was gonna bottom soon. Let's look at the RSI. Let's go to the weekly to see where it's at on the longer term. So to play it safe, Alpha is probably gonna have to bounce around this 30 RSI, right? For the daily. Elf brand usually does pretty well in a recession. So this should do. I mean, Warren Buffett's buying Alta for a reason. Because even if things start to slow, this is one of the you could call it a consumer staple. It's not really a needed product, but come on, it is, right? Is this in the staples industry? I'm not sure. It could be discretionary. For men, it's definitely discretionary. If you're putting on makeup, I don't know, something's wrong. But for women, it is definitely a staple for women. So my guess is even going into November, October, you're looking at October. I mean, you're looking at Halloween. Demand goes up for Halloween for Elf Beauty. I guarantee. November, people got to look pretty. They're going to Thanksgiving, Christmas. I think Elf is near the bottom, even in a recession. It is a staple. The trend is very strong. The earnings are already done. The cycle is down. They beat earnings. I think this thing is overdone. And I would be more optimistic about Elf than Celsius, personally. Just personally. So yeah, I think Elf is going to come. I mean, we're heading into the Santa Claus rally. Once we get into October, that is the point where you see the Santa Claus rally, right? The marketing scheme that gets Americans to consume things they don't need for people they don't care about, and that drives earnings. So I think Elf. I like Elf. I think it looks a lot like, what were we just looking at? It looks a lot like Celsius. That's why I have them right head by head, because they're so oversold. They're so oversold. But the only pressure is the market is tanking, right? So here's what I'd say. Once the S&P really gets oversold, I'll be looking at Elf and I'll be looking at Celsius. Once it gets oversold. What else you got, Vadim? And where's that oversold territory for the S&P? It has a little bit to go, right? You still have, how many points do we have to go for the daily RSI? We have a good, and it's coming into a level. We might bounce here, right? We could bounce, but we're looking at we're looking at about 10 points of momentum. And the whole momentum index from 30 to 70 is 40 points. So we're looking about a quarter of a drop on the momentum to say, all right, where's Alpha at? The S&P should be bottoming now, like it always does. Look at last 2 times, going back 2 years, 3 years, 4 years. No, I'm just kidding. This is really 2 years. 1, 2, 3, 4. It always bottoms at that cooling level. That's when it's overcooled. So once it becomes close to overcooled, flip over to Elf, and it should be bottoming out. And it's so oversold. So I like Elf. I'm just going to trade it differently, not momentum. CrowdStrike. CrowdStrike should bottom out. It's still good company. Coin. I was looking at Coin. I really like Coin. We're heading into the Bitcoin cycle. The way to take advantage of it is to trade options when they get cheap, when the options really start to get cheap. Now, this thing is oversold for sure, but it is tied to Bitcoin. So you need Bitcoin to bounce, and then you can get long calls. Now, I always say I'd rather get long calls into February, because crypto usually, out of the whole year, it only moves 10 times. Like, all of its gains are in 10 days, and we haven't seen many gains, have we? So we're building up to some big moves in crypto. It's probably gonna take the election. That's why if we're electing in November, we're looking at November, December, January, February. So those are a little more expensive calls. You're looking a little further out, But if you're going to do that, you want to do it when the RSI is at its lowest point, when the RSI is getting crushed, when nobody wants to own the stock, when everybody's scared, when everybody sold it all. That's when you start getting the leap calls 3 months out, 4 months out, and you're buying time. You're buying time. Yeah, and I'll end here with Tesla. Tesla looks amazing. I like that nobody's talking about it. That's when it surprises you, when nobody's looking, when nobody's talking about it. It may have some more consolidation to go. But when this thing pops, this probably has the longest trend in the entire market, the longest technical trend. It did this from 2014 to 2018. It consolidated for 3 years and it exploded. It did a 10x. And I think we might see that. Is it this year? Probably going to happen in 2025, but just keep your eye out because you have a giant reverse head and shoulders starting to form here. Okay, and Tesla's tricky, but it's just once you get above that 250 level, I'm going to say it's 250. Once you get above 250 and really start to hold, it's probably more like 300, but of course I want to be early. Once you get that momentum and you have a catalyst and interest rates are lower, and I'm going to end with Tesla because I'm telling you, I was wrong last year. I thought we'd break out last year, but Tesla needs lower margins. Tesla is a cyclical company. It is very sensitive to interest rates because it's driven by the consumer, and the consumer is not going to buy Teslas with the payment so high. So when those interest rates come down, the cost of a Tesla comes down. Guess what? It's cheaper than oil. Guess what? It's cheaper. It's safer. It's faster. It's being adopted. Now you got full self-driving as a possibility. The car becomes an asset. The narrative has not disappeared. It's just been it's been overran by AI. And guess what? This is probably the biggest AI play. It's the real AI play. It's the one that we can own. We don't do anything with NVIDIA chips. Consumers don't mess with NVIDIA chips. That's all CapEx from the hyperscalers, Amazon, Apple, Google. But look at the iPhone. The iPhone is a consumer name. And who owns the iPhone? Apple. They have the biggest revenues in the market. So Tesla has a chance to execute. When does it come? I don't know. But when it happens, when the full self-driving is regulated, as the margins come down, Tesla's going to move quickly to 300, and then it's going to break out to all-time highs. It's the only Magnificent Seven stock that has not made a run to all-time highs. The only one, and it probably has the most momentum by far. We just need those margins to come down. Rates are too high, and once they come down to finance a car, it's game over. So keep your eye out for Tesla. We'll try to stay updated. I'm taking my time. I'm going to do more stuff with the channel going forward, but I'm trying to finish the course to build base knowledge on macroeconomics, in regards to stock market and asset prices, not just economics for the sake of it, but how it relates to markets, how markets respond, how the different financial conditions, how the different economic conditions drive different asset classes. That's my goal. And there will be quizzes. It'll be interactive. And I hope to bring that to you guys as soon as I can. Anyways, I'm out of here. You guys have a safe weekend. Be safe. Watch bonds. The economy is slowing. Bonds should break out. You guys stay blessed. Lift weights. Eat healthy. Learn something new every day. Thank you.